If you have ever bought a stock because a headline sounded exciting, because a friend sounded certain, because a chart looked irresistible, and then watched that same stock begin to fall almost the moment you bought it, then you have already lived through the central problem of investing. Most people think they lose money because they do not have enough information. That is not usually the real reason. Most people lose money because they are looking at the market through the wrong lens. They are staring at movement instead of substance. They are reacting to attention instead of judging value. They are trying to borrow conviction from noise because they never built conviction for themselves. I have spent my life learning one lesson over and over again: the stock is not the business. The quote on the screen is not the enterprise. The crowd's excitement is not the same thing as economic reality. Once you understand that difference, the whole field changes. You stop feeling as if you are being pushed around by every opinion, every thumbnail, every rumor, every green candle, every red candle. You begin to stand on something firmer. That is where real investing begins. A great many people enter the stock market as if they are joining a moving parade. The news reports on a company after the stock has already climbed. A YouTube channel suddenly tells you it is the next big thing after the easy money has already been made. A friend who never cared about stocks before starts speaking with perfect confidence because his position is up. The whole sequence is almost always the same. Price moves first, story comes second, attention arrives third. Public participation comes last, then the public calls that participation research. It is not research, it is delayed reaction. Think about what must happen before a stock appears in the news as something wonderful. It usually has to rise first. Journalists do not possess a crystal ball. They are normally explaining a move after it has happened. The same is true of most market chatter. The thing gets hot first. Then everyone begins to explain why it deserves to be hot. By the time the explanation reaches the average investor, the price already carries a great deal of the optimism. That is why so many people feel cursed. They buy after hearing the story, the stock drops, they sell out of frustration, and then the stock rises again after they are gone. They think they are uniquely unlucky. Usually they are not unlucky at all. They are simply participating at the stage when attention is highest and margin for error is thinnest. My way of looking at the world was built in the opposite direction. I never wanted to begin with applause. I wanted to begin with a business. Is the company making money? Is it making money in a durable way? Can it keep doing that for a very long time? Is the stock price asking me to pay too much for that stream of money? Those are the questions that matter. They are not glamorous questions. They do not give you the emotional thrill that a fast-moving market gives you. But they are the questions that separate investment from speculation. When the whole world is looking at price, you have an opportunity to look at cause. When everyone else is asking whether the chart is strong, you can ask whether the enterprise is strong. When everyone else is asking who is buying, you can ask what is being bought. That difference sounds small when you say it quickly. In practice, it is enormous. People often talk about my long-term record as if it were a mystery, or as if there must be some hidden code behind it. There is no hidden code. There is only discipline around a few ideas that most people find too plain to respect. Over many decades, the annualized return Berkshire has discussed publicly has been close to 20%. If you run rough compound interest math on a number like that across an investing lifetime, the gap between disciplined capital and undisciplined capital becomes so wide that it starts to look unreal. One path can turn a modest sum into something vast. The other path can leave a person exhausted, overtraded, overinformed, and still poor. So where does the gap come from? It comes from what you are actually studying. Most people study excitement. I study economics. Most people study price motion. I study earning power. Most people study the crowd's reaction. I study the company's reality. Once you see that clearly, you also see why so many ordinary investors keep repeating the same pain. They buy because the market has already voted, not because the business has already proven itself. They look at a rising stock and assume that means a rising quality. They look at a falling stock and assume that means a falling value. But price and value are not twins. Sometimes they meet, sometimes they separate wildly. If you cannot tell the difference, the market will make you emotional because you will be using the wrong instrument to measure the right thing. When I look at a company, I do not begin with technical indicators. I do not begin with complicated option structures. I do not begin with a prediction about what strangers will feel next Tuesday. I begin with something much simpler. Is this company making money efficiently? Is this company available at a reasonable price? Can this company be held for the long term with genuine confidence? That is the spine of the whole process. People sometimes hear those questions and think they sound too simple for modern markets. They imagine that because the world has more data, more commentary, more screens, and more velocity, investing itself must have become more sophisticated. In one sense, the world has changed. In another sense, the essential work has not changed at all. A good business is still a good business. A bad balance sheet is still a bad balance sheet. A ridiculous price is still a ridiculous price. Human fear and greed are still human fear and greed. Simplicity is not the enemy. Unthinking is the enemy. Let me start where I always start, with the quality of the business itself. A company must be able to take capital and turn it into earnings with some consistency and some strength. Many people hear a line like that and nod as if it is obvious, but then go out and buy a stock because it is trending or because somebody on the internet sounds persuasive without even checking whether the underlying enterprise is any good at turning money into more money. If you put your own money into a small business and it earns a healthy return on the capital you committed, you immediately understand the appeal. The same principle applies whether the business sells fried chicken, beverages, insurance, chips, or household products. The question is always the same. How productive is the capital inside this enterprise? A rough reference point that many investors like to use is a return on equity around 15% or better. That is not a magical number, and it is not a guarantee of anything by itself. But if a business can maintain a healthy level like that over a long period, it often suggests that something valuable is at work inside the company. Maybe the brand is powerful. Maybe the product has deep customer loyalty. Maybe the distribution network is hard to replicate. Maybe the scale itself gives it an advantage. Maybe the firm operates in a position where competitors cannot easily break in and destroy margins. I have often described that sort of protection as a moat. People love the image because it is memorable, but the idea matters because it is economic. If a castle has no moat, enemies can attack it easily. If a business has no moat, competitors can attack its profits easily. And if competitors can attack its profits easily, the business may look good for a short time without remaining good for a long time. That is why I have always preferred businesses with some enduring character. Think about a brand like Coca-Cola. Competitors exist, alternatives exist, yet habit, identity, taste, distribution, and brand memory all create a kind of resilience that is not simple to copy. A person who prefers Coca-Cola usually does not switch because somebody made a slightly cheaper brown liquid. That kind of staying power matters. It gives earnings a chance to endure. The same logic applies across many industries. Some companies have relationships, locations, customer habits, regulation, or reputation working in their favor. Those things may not look dramatic on a chart, but they often matter more than a chart ever will. But there is a trap here, and it is a trap that catches people who love shortcuts. A business can appear wonderfully profitable because debt is doing the cosmetic work. If you only look at the surface number, you can mistake leverage for excellence. Imagine a small business started with your own capital that produces a healthy return. That is one picture. Now imagine using the same equity base while loading the enterprise with borrowed money, expanding aggressively, and pushing reported returns much higher during good times. Suddenly the numbers look brilliant. The return on equity looks extraordinary. The business looks like a miracle. But the miracle may simply be borrowed gasoline. When conditions are favorable, debt can flatter a company. When conditions turn, debt can crush it. Interest does not care that management had a beautiful growth story. The bill still arrives. Revenue can weaken. Margins can compress. Markets can tighten. And then the structure that made yesterday's numbers look so impressive begins to expose how fragile the whole thing was. I have seen many cases where an investor gets excited by an impressive figure only to discover that the business was leaning on borrowing so heavily that a rise in rates or a drop in demand completely changed the picture. That is why you cannot ask only how much the company earned. You also have to ask how it got there. Did it earn that result because the business is genuinely strong or because leverage dressed the company up for the party? Numbers must be interrogated, not admired. When you look at a company, quality is never just one number. It is the relationship between numbers. Strong returns combined with manageable debt are one thing. Strong returns sitting on top of extreme debt are another thing entirely. You must learn to tell the difference. That is the first layer. Now suppose you have actually found a good business. It earns well, it has some moat, its balance sheet is not reckless. At that point, many people relax too early. They assume that if the company is good, buying the stock must also be good. That is not true. A wonderful business can still be a terrible investment if you pay a foolish price for it. This is one of the great places where intelligence gets confused by enthusiasm. People know how to admire quality, but they forget to examine the price tag. Yet price is what determines the bargain. A magnificent product offered at a laughable price is not a bargain. The same is true of a stock. No business becomes immune to overpayment merely because it is excellent. I have said many times that it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. That sentence contains a great deal more than people realize. It means quality matters. It also means valuation matters. It means greatness alone is not enough. Rationality must be present at the moment of purchase. One simple way people think about this is the price to earnings ratio. A company earns a certain amount per share. The stock asks a certain price for that stream of earnings. Roughly speaking, the ratio gives you a sense of how many years of current earnings you are paying for. A lower number can suggest a cheaper stock. A higher number can suggest a more expensive stock. But again, Shortcuts become dangerous when they are treated as conclusions. Different industries deserve different valuation ranges because different industries grow differently, reinvest differently, and face different levels of stability. A bank will often look different from a fast-growing technology company. A mature consumer business will look different from a cyclical manufacturer. There is no single number that tells the whole story across every corner of the market. And even inside one industry, a low multiple is not automatically a bargain. Sometimes it is simply a warning. Cheap has a biography. A stock may look cheap because the company booked a one-time gain. It sold an asset. It recognized a non-recurring profit. Earnings spiked for a year. The ratio fell. The stock screen now announces a bargain. But the true earning power of the business has not changed in the way the ratio suggests. Next year, the special gain disappears, and the so-called cheapness disappears with it. This is why context matters more than raw arithmetic. You have to separate operating profit from final profit. You have to ask whether the business itself improved, or whether accounting benefited from an event that will not repeat. If the core engine did not get stronger, then the cheap-looking multiple may be little more than a costume. The same is true when investors look at assets and use a price-to-book ratio. In theory, buying a company below the value of its net assets sounds attractive. In practice, you must ask what those assets are worth in the real world. A decaying factory in a declining industry may sit on the books at a generous value while being worth far less to any actual buyer machines from a dying line of business. Do not become wonderful simply because an accountant once assigned them a large number. That is why I have never believed in worshiping numbers without understanding the business. Those numbers describe. Ratios are clues, they are not verdicts. The question is never only whether a stock looks cheap. The question is why it looks cheap. Is the market temporarily distracted, fearful, or indifferent? Or is the market detecting a weakness the casual observer has not bothered to understand? You do not need a complicated answer to every valuation problem. You do need honesty. You need to be willing to say, I do not know enough yet. You need to be willing to wait. One of the most underrated acts in investing is doing nothing until the price and the business line up in a way that truly makes sense. People think action feels like intelligence. Often patience is the real sign of intelligence. I knew plenty of businesses long before I bought them. Knowing a company exists is not the same as having a price you can live with. Understanding a business does not obligate you to own it today. If the valuation is wrong, the sensible response is not to force an idea. The sensible response is to wait until the market offers terms that respect your standards. This is one reason Berkshire has often held substantial cash. People like to imagine that cash means ignorance, fear, or laziness. Often it means discipline. Cash is the residue of standards. It is what remains when you refuse to buy merely because you are restless. The market is under no obligation to give you an opportunity on your schedule. Your job is to be ready when the opportunity arrives. Now let us go one layer deeper, because even after you find a strong company at a sensible price, there is still a question that matters enormously. Can this business be held for the long term? A great many investors never really ask that question. They say they are long-term investors, but what they actually mean is that they hope the stock rises soon, and if it does not, they will begin searching for a new story that is not long-term investing, that is short-term impatience, wearing long-term language. If I am not willing to own a stock for a very long time, I should not own it for a very short time either. The reason is simple. A stock becomes easier to hold when the underlying business gives you a credible reason to remain a partner. One of those reasons is the economics of the business itself. Another is what the company does with its profits over time. Dividends are not the whole story, but they tell you something important. A company that can share cash with owners year after year while maintaining or growing that distribution responsibly is showing you that the business creates more than accounting fiction. It is producing economic value that can be passed back to owners. Take Coca-Cola. I began buying it in 1988, and I have never felt much urge to part with it. Over the decades, the company has paid dividends every year, and those dividends have trended upward over time. The business has been understandable, durable, and productive. People still drink the product in good times and bad. When a business continues to serve customers, continues to produce cash, and continues to share that cash with owners, time begins to work for you instead of against you. At the beginning, a dividend yield may look modest. Over a very long period, if the company keeps raising the payout, the cash return relative to your original purchase price can become striking. That is one of the quiet beauties of compounding. Early numbers can look ordinary. Patient ownership can make them extraordinary. But once again, there is a trap for people who use shortcuts. A high dividend yield is not a synonym for safety. Sometimes a stock looks generous not because the business is thriving, but because the stock price has collapsed. The yield rises mathematically as the price falls. On paper, the payout now looks irresistible. In reality, the market may be warning you that the business itself is weakening, so you cannot ask only whether the yield is high. You have to ask whether the dividend is steady, whether it has room to grow, and whether the company is paying it from actual earning power rather than self-destructive optimism. A useful discipline is to examine the payment history. Has the company paid consistently for several years? Ideally longer. Has the payout grown over time, or has it stagnated or shrunk? And what share of profits is being distributed? If the company pays out a sensible portion of earnings, it may be balancing shareholder return with reinvestment for the future. If it pays out virtually everything, or even more than it earns, the arrangement may not be durable. A business cannot keep pretending forever. Long-term ownership requires long-term economics. That is why I do not want a company that only looks good in a single season. I want a business that can live through seasons. I want a business that can still make sense after fashions change, after market narratives change, after fear comes and goes, after optimism comes and goes. And that means at some point you have to read the report card yourself. People hear the phrase financial statements and immediately imagine a wall of jargon. They assume this part is reserved for specialists. It is not. You do not need to become an accountant to understand the broad truth of a company. You need to know what each statement is trying to tell you. The income statement tells you whether the business is earning. Revenue shows you what is coming in through sales. Operating profit shows you what remains after the core costs of running the business. Net profit shows you what is left after interest, taxes, and other items. If revenue climbs while operating profit weakens, something deserves scrutiny. Maybe costs are getting out of hand. Maybe the company is buying growth at the expense of profitability. Maybe the economics are less attractive than the sales line suggests. The balance sheet shows you what the company owns and what it owes. Cash, inventory, equipment, property, receivables, liabilities, borrowings. This statement tells you whether the structure underneath the story is strong or strained. A manageable debt burden gives a company room to survive stress and seize opportunities. A dangerous debt burden can turn a temporary problem into a permanent wound. The cash flow statement tells you whether the profits you admire are actually turning into cash. A business can appear profitable on paper while starving for cash. In reality, sales booked but not collected, earnings recognized but not realized, promises made without liquidity behind them. A company can present accounting profit and still run itself into a corner if cash does not genuinely arrive. That is why operating cash flow matters. I want a business whose core operations are actually producing cash, not merely producing hopeful numbers. These are not abstract ideas. They are the machinery behind conviction. Without this work, you do not own a reason. You only own a ticker symbol. And even that is not enough by itself, because a company does not live outside history. It lives inside an industry. No matter how pretty the numbers look today, you still have to ask whether the world that made those numbers possible is likely to remain friendly to the business. This is where many investors get trapped by backward-looking evidence. They see a fine report card. They see solid profitability. They see sensible valuation. They assume the future will resemble the recent past. Sometimes it will. Sometimes it will not. Kodak is one of the classic examples. There was a time when the company looked successful by many conventional measures. It was profitable, it paid dividends, it was recognizable, it seemed embedded in everyday life. Yet the underlying world was changing. Digital photography was not a small adjustment. It was a structural shift. And a business built on the old foundation could not simply preserve itself by wishing that change away. Numbers looked respectable until the world around the company stopped respecting the old economics. That is why durability matters so much to me. I prefer businesses that exist in fields with a reasonable claim on the future. Consumer staples, financial services with enduring roles, insurance, communications, products and services that people keep using regardless of fashion. I am not against change because I dislike technology. I am against pretending certainty where certainty does not exist. The faster an industry can become unrecognizable, the more cautious I become about projecting earnings far into the future. Predictability is not exciting. Predictability is valuable. A person can mock that preference in bull markets. During bubbles, restraint always looks old-fashioned. During manias, understanding looks slow. During the internet era, many people said, my time had passed because I refused to buy businesses I did not understand. Then the bubble burst. Restraint did not look so foolish after that. Later I bought Apple in size, but only after I felt I understood the economics well enough. Not because somebody called it hot, not because I wanted to join the noise, because eventually the business made sense to me in terms I could respect products, ecosystem, customer behavior, services, economics. If I understand it, I can act. If I do not, I pass. That principle has saved me more money than any clever trick ever could. Now let us talk about what happens after you buy, because this is where real people usually fail. They think the hard part is selecting a company. Often the harder part is behaving correctly once money is on the line. Suppose you found a good business. Suppose you bought it at a sensible price. Then the stock falls. What do you do? The first thing is not a panic. The first thing is to diagnose. Has the company itself deteriorated, or is the whole market in distress? Those are not the same event. When the entire market falls into fear, strong companies are often dragged down with weak ones because panic is not subtle. In moments like that, prices move faster than thought. During the pandemic panic, a great many stocks fell sharply in a short stretch of time. But not every business that fell had suddenly forgotten how to earn money. Some were suffering temporary anxiety from the market rather than permanent damage to the enterprise. If the underlying business remained sound, a falling stock price did not automatically create a reason to sell. In some cases, it created a reason to buy more. This is the point of the old line about being fearful when others are greedy and greedy when others are fearful. It is not a slogan meant to sound clever. It is an instruction about where opportunity usually hides. Opportunity rarely appears when everyone feels comfortable. It appears when everyone feels sick to their stomach. Most people reverse the logic. When prices are rising, they feel secure, so they buy. When prices are falling, they feel endangered, so they sell. That is how the crowd repeatedly turns volatility into self-harm. Selling itself is not forbidden. It simply needs a real reason. There are times when you should sell if the business you bought has changed for the worse. The original logic may no longer hold. If the company was attractive because it had strong returns on capital, and those returns keep deteriorating, that matters. If you bought it for durable dividends, and the dividend is cut for reasons that point to lasting weakness, that matters. If the industry itself is becoming structurally less viable, that matters. Ownership is not a marriage vow to a mistake. There can also be situations where another opportunity is genuinely better, and your capital is limited. But this kind of switching should be rare and disciplined. Constant motion creates fees, taxes, friction, and confusion. The market already gives you enough problems without your own restlessness adding more. And yes, a stock can become absurdly expensive relative to reality. In those cases, selling may be justified. But even here you have to be careful. People love the feeling of outsmarting a rising market. They tell themselves they are trimming because they are rational, when in fact they may simply be impatient with a wonderful business. Good businesses sometimes look expensive and then become more expensive. You do not want to turn valuation into a ritual of perpetual premature selling. That is why judgment matters more than formulas. Now we arrive at the part of investing that has far more to do with temperament than with intelligence, impatience, greed, fear. Those three forces destroy more portfolios than ignorance alone. Impatience is what makes a person feel betrayed, because a good stock did not go up in 3 months. They bought an ownership claim on a business, but what they really wanted was quick emotional validation. They do not say that out loud, but the behavior reveals it. If the market does not reward them immediately, they begin to doubt the decision. Yet a business does not become better or worse because the stock slept for a season. If the economics remain intact, time is not your enemy. Restlessness is your enemy. Greed appears when success begins flattering the ego. A stock rises. The owner begins to imagine not only that he was right, but that he is uniquely gifted. The temptation then is to add thoughtlessly, to chase strength not because value remains compelling, but because excitement feels like confirmation. This is how people buy heavily near peaks. They mistake a rising price for proof that the future owes them more. Fear is the mirror image. The stock falls. The owner no longer cares about analysis. He wants relief. The urge to stop the pain becomes stronger than the urge to remain rational. So he sells at the very moment when the market is offering him either a discount or, at minimum, an opportunity to think more clearly. Fear compresses time. It makes temporary discomfort feel permanent. It turns a paper decline into a spiritual emergency. If you do not know why you own something, these emotions will own you. That is why learning matters so much. People often say, I spend my days reading. That description is basically right. I have never seen reading as decoration around investing. Reading is how you build the mental furniture that lets you sit still. Without that foundation, every headline can move you. Every chart can frighten you. Every confident stranger can borrow your judgment and replace it with theirs. Conviction is not stubbornness. Conviction is informed calm. When you have done the work, a decline in price does not automatically become a threat. It becomes a question, has reality changed or has emotion changed? If only emotion has changed, the market may be offering you better terms rather than worse prospects. But if you skip the work, you cannot ask that question honestly. You can only react. This is the great divide between those who merely participate in markets and those who actually invest. The participant rents opinions, the investor builds them, the participant watches price and then searches for a reason. The investor studies reason and then compares it with price. The participant feels late, rushed, excluded, excited, ashamed, jealous. The investor still feels emotions, but he has a framework stronger than the emotions. That framework does not need to be complicated. In fact, it is often better when it is not. You want a company that makes money well. You want to avoid being fooled by debt, one-time gains, and accounting costumes. You want to buy at a price that leaves room for reality. You want a business durable enough to hold. You want to understand the statements well enough to distinguish profit from cash, strength from strain, and temporary glamour from durable economics. You want to place the company inside an industry with a future you can reasonably imagine. You want to act only when the business and the price line up. You want to stay calm enough after buying that you do not betray your own work. That sounds simple because it is simple. It is also difficult because human beings are not simple. Most people do not fail because the method is hidden from them. They fail because they keep replacing the method with mood. They know they should look at the company, but price movement is more emotionally vivid. So they look at price, they know they should wait for valuation, but activity feels productive. So they force a trade, they know they should think in years, but the screen updates every second. So they surrender to minutes. That is why the stock market transfers wealth not merely from the uninformed to the informed, but from the impatient to the patient, from the reactive to the disciplined, from the person who wants stimulation to the person who wants results. There is something else you should understand. Doing nothing is not the absence of investing. Sometimes it is the highest form of investing. Waiting is not weakness. Cash is not shame. Refusing to overpay is not missing out. It is protecting your future from your present impulse. When you learn to wait, you stop letting the market define your pace. You stop needing every day to contain opportunity. You accept that most days will not deserve your capital. That acceptance is liberating. It allows you to preserve energy, preserve judgment, and preserve cash for the moments that actually matter. The market does not reward constant motion. It rewards correct motion, and correct motion is often sparse. I am not telling you that investing is effortless. I am telling you that the hard part is not where most people think it is. The hard part is not discovering some secret stock before others do. The hard part is becoming the kind of person who can separate business from price, value from excitement, patience from passivity, and conviction from ego. That is why so many ordinary investors can read the same books, watch the same videos, hear the same principles, and still end up in completely different places. One person treats the market like a voting machine and spends his life reacting. Another treats the market like a place where ownership interests are sometimes mispriced and spends his life judging. Over time, those two mentalities do not merely produce different trades. They produce different destinies. If you want to invest the way I have tried to invest, then do not begin by asking which stock will go up next week. Begin by asking what kind of business deserves your partnership. Ask how that business earns. Ask whether competitors can injure it easily. Ask whether the balance sheet is carrying hidden danger. Ask whether the earnings are real and cash-backed. Ask whether the price is fair. Ask whether the industry still has a future. Ask whether you would feel comfortable owning the business if the stock market closed tomorrow and stayed closed for years. That last question filters out a great deal of foolishness because once you ask it honestly, many so-called opportunities lose their shine. You realize you were never buying a business at all. You were buying a temporary story, hoping somebody louder would come along and pay more for it. That game can make money for a while. It can also make misery for a very long while. I never wanted to build my life on the need to be rescued by the next buyer. I wanted to own economic engines. I wanted to own businesses that could keep producing. I wanted to buy them on terms that made sense. I wanted time to be my partner, not my prosecutor. If you can learn to think that way, the market becomes quieter, not because the noise disappears. The noise never disappears. It becomes quieter because you no longer need to obey it. Then when a stock rises, you do not automatically celebrate. You ask whether value still justifies action. When a stock falls, you do not automatically panic. You ask whether the business has changed. When the crowd becomes euphoric, you do not feel forced to join the parade. When the crowd becomes terrified, you do not feel compelled to run with it. You become harder to manipulate because you are anchored in something more durable than mood. That is what most people are missing. They think the difference between losing money and making money is a matter of being faster, smarter, more connected, more up to date. Often the difference is that one person is still staring at the stock while the other is looking through the stock to the business underneath. I have never believed that the route to wealth had to feel theatrical. I never believed you needed complexity to deserve returns. I never believed a person had to predict every market move to do well. I believed, and still believe, that sound judgment repeated for a very long time can outperform brilliance used emotionally. Find a good business, understand why it is good. Make sure the numbers are real. Make sure the debt is tolerable. Make sure the price is reasonable. Make sure the future of the industry is not collapsing beneath your feet. Buy only when the terms make sense. Then if the business remains sound, give time room to do what time does best. That is not glamorous. It is not designed for people who need constant stimulation. It is not built for those who want the market to flatter them every month. It is built for people who would rather be right than entertained. In the end, that is the choice in front of every investor. You can keep living at the surface, buying because the world is talking, selling because the world is screaming, and calling that activity investing. Or you can step underneath the noise, learn how businesses actually work, demand a sensible price, and let patience carry more of the load. One path feels active and often ends in regret. The other path feels quiet and often ends in wealth. The market offers both every day. The decision is not made on the screen. It is made in the mind before the screen ever lights up.